Hello everyone, this is Mridul Pandey and in this video we are going to cover the topic of national income. The main things that we are going to discuss in the topic of national income are introduction, the types, new GDP methodology, GDP deflator and per capita income. Before starting the topic, I want you guys to think about it once. Why do we need national income? National income is required to measure the development of a country, how government is performing. To know all these things, we need to know about production, our national income. The first attempt was made by Dadabhai Naoroji to do so. Now we have different types or different aggregates that we use, and the types and aggregates we use are GDP, that is gross domestic product, GNP, gross national product, NDP, national domestic product, NNP, net national product, and NI, that is national income. If we talk about GDP, GDP is the total monetary value of all the goods and services produced within a geographical area within a particular time period. Let's say we have to measure the GDP of Maharashtra. We will take the geographical area of Maharashtra. We'll calculate all the goods and services produced within the boundary of Maharashtra within a particular time period, maybe for 1 year, for 1 month, depends totally on you for what time period you want the gross domestic product of that particular area. Okay, so this is GDP. Now when we take the goods, the monetary value of the goods, we will not take intermediate goods, we will take the final goods that are produced. Okay, the final goods we will be the monetary value of the final goods will be calculating to get the value of GDP. Now we have three methods: output, that is product value method, income value method, and expenditure method. Now we will discuss about all these three methods in detail. Okay, so before starting about this output method or income method, expenditure method, let's understand some few things about GDP. Only the final product is counted, as I told you. Commissions on resale is counted on GDP. Commissions on resale, because commission is a kind of service. Okay, but on resale of a product, suppose I have a car and I'm selling it to someone. I'm using that car for me. It is a car of my personal use, or maybe for school I have a school bus and I'm going to resell that school bus. So it will not be counted in GDP because it is already have been used it, and it was already counted in previous years whenever I would have purchased it, right? So in GDP, we will not take the resale value of anything, and we will add the commissions on sale of anything, and even on resale of anything, because that is a service. Okay. Now let's understand output or product value method first. See, the total cost incurred in the production. Total cost incurred in the production of anything. We sum up all the cost incurred in production of all the things, all the goods we have, and we multiply it with the market price of the respective good, and we get the value of GDP by this method, that is output or product value method. Now what is income method? Sum total of all the income on service provider put together is called income method. It is the sum method of all the income on service provider put together is called income method. What is expenditure method? Expenditure method is total production of India. If we take the total production of India, some of the production of India will be consumed in the territory of India and some of the items will be exported. Total production of India, suppose rice, some of the rice we will consume, and maybe some of the rice will export If we have that in abundance, we have that rice in surplus, we will export that rice, right? Suppose bikes, Bajaj is manufacturing Pulsar. Many people in India are consuming, utilizing that Pulsar. They are purchasing the Pulsar, and some of the people are exporting it, and many of the Pulsar are exported to another countries. So similarly, the consumption in India, many people are using Indian products that are produced in India, and many people are using imported products like cell phone. Many of us are using cell phone of another country. Motorcycle, computer, AC, all these things, many of the things we can see all around us are imported, and many of the things are indigenous, right? So we get the value of C plus I plus G plus X minus M. Let's understand this in details. What is the expenditure method and what this formula is all about? Okay. Now when I say C plus I plus G plus X minus M, as you can see on the screen, C is for household consumption. Household consumption, that is consumption by Indian people. Total consumption by Indian people, okay? Now the company's consumption, many of the companies are consuming many of the things. Their consumption are added also. So that is I. And G, that is government's consumption. Government is also consuming. So the three parties, the common people, that is in household, in government sector, and in companies, all these three parties are consuming. So their consumption is added. That is the total consumption of India. C plus I plus G is the total consumption of India. C for household, I for companies consumption, and G for government's consumption. Total consumption of India plus export, because we are getting money, we are selling our services, we are selling our products to another countries. So export minus import, because we are purchasing the services of some other countries, we import. We are purchasing the product of another country, that is import, right? So total consumption of the country plus export minus import. It's simple. Total consumption of the India, total consumption of India plus export minus import, it gives the value of GDP by expenditure method. Okay. Now who used to do this? CSO calculates this, Center Statistical Organization. Now which method they used to do this? They use the method of output or product value method and expenditure method. Product value method and expenditure method is being used by CSO. See, we need to discuss two important points from prelims point of view. That is, the base year it changed from 2004 and 5 to 2011 and 12. And we need to understand that these things are important. We need to change the base year because there are many services at the present time which were not available in 2004 and 5. The technology we have in 2011 and 12 were not present in 2004 and 5. Some new sectors have evolved during this period, and it will keep on evolving. So this base year needs to be changed over the period of time. Okay, and we need to know about SNA, that is System of National Accounts. It was prepared by United Nations in 1992, but later on it was upgraded in 2008, ratified by World Bank, IMF, etc. Now we have to discuss about methodological change. These things are important, so pay full attention. What are the methodological changes? The first one is the coverage shifted from ASI to MCA. Now what is this MCA 21? See, these two things are methodologies. You can see here ASI stands for Annual Survey of Industries. So survey is done by ourselves. Okay, industries have no role to play, but in the method of MCA, Ministry of Corporate Affairs, what methodology they are using? The company themselves will report their output, their production, the cost incurred, all these things to Ministry of Corporate Affairs in this methodology. While in ASI, they took the data directly from registered companies. So this is the difference. Okay. So now we have shifted to MACA. Companies themselves will report things. Clear? Now we have shifted from cost price to market price. Why we have shifted from cost price to market price? See, there is a point behind this. Cost price can be changed. Can be changed when subsidy is added or tax is imposed. Cost price can change, right? Cost can be reduced when subsidy is given. Cost price can increase when a particular tax is imposed on them. So it will affect the cost price. So market price will be taken. Okay. Now we have shifted to GVA methodology. What is this GVA methodology? That is gross value added. Okay, or gross value addition methodology. Earlier we were using index of industrial production that measures the variation in the volume of production, while GVA, gross value addition, measures the value of production. Okay. IIP, industrial index of industrial production, what it measures? It measures the variation in volume of production, but GVA measures the value of production. Okay. And the fourth change is effective labor input. That we understand input of every labor or efficiency of every labor is different. Okay. Now we have to read about GVA, how GVA is calculated, how it is added. Okay. See, it is clear that GVA, gross value addition, is the value added by all the sectors of the company in our economy. That gives the GVA, right? So how it is calculated? The total consumption, that is the value added in the economy, minus the consumption of intermediate goods. Why we are subtracting intermediate goods? Because it will be calculated twice. Let me give you an example. Suppose Seat company is producing tire and Royal Enfield company is purchasing the Seat's tire, and Hero and Bajaj also are purchasing that Seat tire, right? Now what happens if you will calculate the value of intermediate goods also? When Bajaj or that Royal Enfield company purchased the tire from Seat company, it will be calculated. Now again it will add the value of tire plus its profit along with the bike, and then it will sell it to the customer, the final consumer. Suppose you are going to purchase a Himalaya bike, it is not going to charge you extra for the tire. The price of the tire is added in the price of that motorcycle. Okay. So it will be calculated again along with the price of the motorcycle. So it is added two times in our calculation. This is the mistake. So that's why we subtract the price or the value of intermediate goods. So market price of all the production minus the intermediate goods. That is the summation of gross value addition of all the sectors that gives the GDP of a country. Is it clear? Now when we talk about market price, market cost, what is the market cost? Why we are taking the market cost? Because as we already have discussed, cost price have effect of GDP, subsidy and taxes on it. We cannot leave it because it is affecting the final price, right? So subsidy will reduce the price of any product. Suppose my production cost is rupees 500, I am getting the subsidy of 50, so my production cost will be for 50, है ना? Similarly, tax will add to the cost. I am paying rupees 25 as the cost, so 450 plus 25, See, things are clear with this example only, right? So 450 plus 25 is the final thing. So basically what we did, in the cost price, we added indirect tax, that was 25 rupees in this example, and we subtracted the subsidy, that is rupees 50 in this example. So from 500 we subtracted rupees 50, that is the subsidy, we added indirect tax, that is 25, it becomes 475. Clear? Now we have taxes of two types. One is production tax and another is product tax. Product means the particular product tax, and subsidy, again we have the same types of subsidies, production subsidy and product subsidy. Now if we have the production subsidy or production tax, it will be independent of the goods produced, it will be same for all, doesn't matter. But particular product tax, it will depend on associated product, on the product that is associated with it. And similarly the product subsidy, it will be associated with the product. Now the formula we just used to calculate the market cost, it actually gives us the basic price at which the product can be sold without any loss, if we are not adding that all those things, transportation and etc., because these things are already being calculated while we are calculating the whole of the value in service things, right? So is it clear? Is there any confusion? When we are calculating GDP, we get the basic price of all the production of the country, of goods and services, everything. Okay? Now as I told you 2 pages back that we are not taking IIP, Index of Industrial Production, in GDP calculation. Why? Because in GDP we are adding services as well, but in Index of Industrial Production, how will be taking the services? So that's why we are not using IIP methodology. Now do you know about GDP deflator? What is GDP deflator? See, GDP is measured using the current year price. What is the price today? We calculated GDP according to that price only, and that gives the nominal GDP. But on comparing it with the base year, when the prices were less, we compare the GDP on current market price with the price of 2011-12, that is the base year. Initially it was 2005 and 6, now we are comparing it with 11 and 12. So again there is inflation in between it, right? And there will be an effect of inflation, obviously. So to de-effect that inflation, that means to adjust that inflation, GDP deflator is used. So GDP at current year price is nominal GDP. GDP at base year price, we will come to the base year by adjusting the inflation. Okay, so that is called the real GDP. And the formula of GDP deflator is nominal GDP divided by real GDP, that takes out the effect of inflation over these periods. Okay, now in India, if we are not using IIP methodology, we are using methodology of WPI, that is wholesale market price are taken. Okay, so we will understand about this in detail. Up to now, if you have any confusion, any doubt, please write it in the comment section. I'm ending the video here. We will cover the rest of the chapter in my second video. So stay connected, just share the video with your friends and press the bell icon so that you will get notification when the second video of the chapter will be uploaded. So thank you. See you all tomorrow and best of luck for your preparation. Thank you.